Welcome to our deep dive into the MACD indicator. In this video, we've combined information from a variety of sources to present you with a full overview of the MACD indicator. We built this video course for traders of all skill levels, so whether you're a beginner or an experienced trader, viewing the complete video will help you comprehend each idea in depth. We'll start with an overview of the MACD indicator, describing what it is and how it works. This will involve careful investigation of its components, including the MACD line, signal line, and histogram. Following that, we'll dig into the MACD indicator's various applications. We'll look at the histogram slope, crossovers, zero-line crossovers, zero-line pullbacks, and divergences, gaining a thorough grasp of each. You will learn how to use these strategies to locate potential trade opportunities. Finally, we will combine the MACD with other concepts to create 4 advanced techniques that may be applied in a variety of market scenarios. You will learn how to use the MACD to trade both reversals and trends. Let's dive right in. What is the MACD indicator? MACD stands for Moving Average Convergence Divergence. It is used to detect trends and momentum in price fluctuations. The MACD indicator consists of 3 components: the MACD line, the signal line, and the histogram. Let's look at each of these components in depth, beginning with the MACD line. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. This formula implies that when the 12 EMA is greater than the 26 EMA, the MACD line will be greater than 0. In contrast, when the 12 EMA falls below the 26 EMA, the MACD line will drop below 0. The signal line comes next. The signal line is a 9-period exponential moving average of the MACD line that serves as an entry trigger through crosses. Finally, we have a histogram. The histogram calculates the distance between the MACD line and the signal line, giving us a better picture of the momentum. When the MACD line crosses over the signal line, the histogram shows green bars above the zero line, suggesting that the price is in an uptrend. When the MACD line falls below the signal line, the histogram displays red bars beneath the zero line, indicating a downtrend. So, the MACD has 3 components: the MACD line, the signal line, and the histogram. Now, let's look at how to apply these components in different market scenarios. Use 1 histogram slope. The histogram slope or form reveals more about the trend. When the price is in a strong trend, the gap between the MACD line and the signal line widens, causing the histogram to expand. An expanding histogram implies that momentum is increasing. As a result, if the histogram is expanding, we should consider making trades in the direction of the trend. Conversely, as the trend weakens, the histogram shrinks, indicating that momentum is fading, and the price may reverse or move sideways. In these instances, it is best to quit trading and wait for the price to regain momentum. The MACD histogram on TradingView is color-coded for easier visual comprehension. Dark colors show when the histogram is increasing, whereas light colors imply that it is receding. When 2 or more dark green bars with a growing histogram appear at the start of an upward advance, it indicates that the upward momentum is strong and increasing. This is an excellent time to hunt for buying entries. When the histogram begins to decline or decrease its time to close the transaction. This suggests that momentum has lessened and a reversal or sideways trend may emerge. As shown, the shrinking of the histogram corresponds to this sideways range. Following this, we see a downward trend with dark red bars and an expanding histogram. If you haven't already, here is your last chance to exit your earlier buy positions. The dark red bars indicate that new sellers have joined the market, resulting in significant momentum. It's time to investigate new sell trades. As the price moves a given distance, the histogram starts to shrink. The presence of light red bars indicates that the downtrend is losing momentum and may be reversing or moving sideways. As illustrated, the price drifted horizontally as the histogram shrank. Remember that this is only one application of the MACD. You should not make your trading selections purely based on this factor. We'll show how to mix it with other aspects in advanced methods. If you found this video helpful, please like it and subscribe to our channel Trader Yoda so you don't miss out on any future information. Now, let's get to the second use. Use two crossovers. Many traders prefer to use the moving average crossover strategy for their trades. However, crossovers usually happen after a major price change. As a result, entries are frequently delayed, and the price may have already changed significantly. To address this issue, we can use the MACD crossover. The MACD crossover can provide an early warning of a reversal, resulting in better entry points and lesser stop losses. To demonstrate this, I have plotted the 12 and 26 EMAs on the chart beside the MACD. This contrast is particularly noteworthy given that the MACD is based on the 12 and 26 EMAs. Here is the point at when the price reversed from an uptrend to a downtrend. The moving average crossing happened at this position, thus your entry would have been on this candle. As indicated, the price had already moved a significant distance before the crossover signal was issued, requiring a large stop loss placed above this high. In contrast, with the MACD, your entry signal would have occurred on this candle when the MACD line crossed beneath the signal line. This provides a far better entry price and a tighter stop loss, allowing you to capture a larger share of the price movement. Here's another example. On this candle, the 12 EMA crossed above the 26 EMA, indicating a bullish crossing and a buy entry. However, this crossover occurs only after the price has moved a particular distance. On the other hand, the MACD crossover occurred here, giving us a much better entry price. As a result, we were able to capture a large chunk of this move by using a tighter stop loss. MACD crossings can detect reversals early, but they also produce more false signals. Therefore, they should not be utilized alone. Use 3 zero-line crossovers. The zero-line crossover provides a more dependable signal. The MACD features a zero line, which represents the indicator's midway. When the 12 EMA crosses below the 26 EMA, the MACD line falls below the zero line, suggesting that the trend and momentum have turned downward and a downtrend may begin. When the 12 EMA crosses over the 26 EMA, the MACD line rises above the zero line, indicating that the trend and momentum have switched upward, implying a possible upswing. Zero-line crossovers typically give fewer misleading signals. However, more confirmations are required to achieve high-probability trades. Use 4 zero-line pullbacks. In strong trending markets, use zero-line pullbacks. During strong trends, the MACD line frequently pulls back to zero, causing the price to rebound again. In an uptrend, if the MACD returns to zero, it is a favorable time to buy. However, we should not buy just because the MACD line crosses zero. Before entering a buy trade, we must first wait for the MACD to pass above the signal line. Similarly, in a downtrend, if the MACD line falls back to zero, it's a good time to sell. We should wait for the MACD line to cross below the signal line before proceeding to the crossing. Let's check out the final application. Divergence. Divergence is a strong signal of prospective reversals and can be quite valuable for detecting trend changes. A divergence happens when the price and MACD generate divergent results. These divergences will be identified using a histogram. There are two kinds of divergences, bullish and bearish. A bullish divergence occurs when the price makes a lower low, while the MACD produces a higher low. This suggests that the momentum during the most recent down move was weaker than the before downwards. It indicates that sellers are losing power and the price is likely to decline or fall. Consider a downtrend in which the price forms three lower lows, each one lower than the previous. Meanwhile, the MACD creates higher lows. This significant divergence implies that selling pressure is decreasing and a reversal is possible, making it a strong buy signal. In contrast, a bearish divergence happens when the price reaches a higher high, while the MACD produces a lower high. This demonstrates that the momentum on the most recent up move is lower than on the prior one. It indicates that buyers are losing strength and the price could stop or reverse. For example, in an uptrend, if the price makes a higher high but the MACD makes lower highs, this is a clear bearish divergence. It indicates that purchasing momentum is weakening and sellers may intervene to force prices lower. Many traders struggle to spot entries based on divergences. But don't worry, we'll explain our unique technique in the strategy section. A quick note on divergence. Only evaluate divergences that are apparent and obvious. They should be clearly visible to the naked eye. For example, if the price hits a higher high, but the MACD indicates lower highs, but the divergence is not obvious, the two peaks may appear to be the same at first glance. It takes a closer look to see if the second top is indeed lower than the first. In such instances, it is important to avoid less obvious divergences. A noticeable divergence occurs when the price makes higher highs and the MACD makes lower highs. This form of divergence is more obvious and should be addressed. Clear divergences can be quite powerful and effective. These were the 5 applications of the MACD indicator. Now, let's talk about the strategies that can be built around the MACD indicators. The first 2 methods are reversal settings, but the last 2 are trend-following ones. These 4 tactics will help you trade under any market conditions. You can use these reversal setups when the price is in a range or during big movements. The following tactics will help you catch pullbacks. Strategy 1. Divergence plus support and resistance. Divergence, as previously said, is a powerful reversal indicator. However, not every divergence is worth trading. To increase accuracy, we must identify probable reversal places and wait for the MACD to indicate divergence at those points. This method includes the principles of support and resistance. First, determine support and resistance levels over a higher time range. Then, check for divergence at a lower time range. Here's an example. We have a 4-hour chart of the GBP-USD pair. The price moved up and then reversed, forcing us to plot a resistance level. When the price approaches this resistance level for the second time, we expect a possible bearish reversal. We then turn to a 1-hour chart to look for divergences. On the 1-hour chart, we can see that the price reached a higher high around the resistance level, but the MACD indicates lower highs. This is a clear and unmistakable bearish divergence, showing that buyers are losing momentum as they near resistance. When the resistance level and divergence coincide, this creates a high probability trade setup, indicating a sell trade. To enter, find the lowest point between the MACD peaks. Mark this point with a line. Wait until the histogram breaks below this line. When the histogram breaks below the line on the corresponding bar, place a sell order. As demonstrated, this resulted in a strong downward move following our entry. Here is an example of a buying setup. We have a 4-hour chart of the USD JPY. The upward reversal enabled us to locate a support level. When the price returns to this level, we anticipate it will find support and proceed upwards. Moving to a 1-hour time period, we are looking for a bullish divergence. The price forms a lower low near the support zone, while the MACD indicates a higher low. This is a clear and noticeable divergence, indicating that sellers are losing strength and momentum. This setup has been identified as a high probability trade opportunity or setup. We now mark the highest point between the MACD bottoms and draw a line at this bar. When the histogram breaks above this line, it indicates a buying opportunity. As a result, we initiated a purchase trade here. As seen, the price thereafter rose and neared recent highs. This explains how to successfully combine divergence, support, and resistance ideas. Strategy 2. Divergence plus Bollinger Bands. Bollinger Bands are a popular indicator for trading reversals. Bollinger Bands are based on the idea that the price will remain within these bands 90% of the time. As a result, when the price swings outside of the bands, it is expected to reverse and return inside. If the price moves over the top range, it is likely to reverse downward. Conversely, if the price falls below the lower band, it is predicted to reverse upwards. We shall apply this notion to MACD divergence. First, modify the Bollinger Band settings. Increase the length to 200 and keep the standard deviation at 2. This adjusts the Bollinger Bands to a 200 period moving average. Here's a sell setup based on this strategy. The price was in an uptrend and had been above the upper Bollinger Band for an extended period, indicating a possible reversal. We then seek bearish divergence. In this case, the price reached a higher high, while the MACD histogram showed a lower high. Notably, no green bar appeared on the histogram for the second peak. This indicates that sellers are gaining control and a price drop is expected. This creates a selling opportunity. For this technique, the entrance point is the first candle that closes back inside the bands. This candle represents our entry point. As indicated, the price dropped significantly following our entry. Moving on to a buy trade setup. At first, we saw a strong down move that kept the price below the lower band for an extended period. Because the price cannot continue outside the bands for long, we expect an upward reversal. Towards the end of the move, we can see that the price was continually making lower lows, but the MACD histogram was projecting higher lows. This is a clear and unmistakable divergence, showing that the selling has lost momentum in the downward trend. A combination of Bollinger Bands and MACD Divergence indicates that buyers are gaining strength, and an upward reversal may be imminent or will happen soon. Therefore, a buy trade should be explored. Our entry happens when the price closes over the lower band of this candle. As demonstrated, the price rose sharply following our entry. This demonstrates a novel approach to trading MACD Divergence with Bollinger Bands. Let's move on to trend trading tactics. Strategy 3. EMA bands plus zero line pullbacks. This method requires 4 indicators, the MACD and 3 exponential moving averages. All 3 have 200 EMAs but use different calculations. The upper EMA is based on the candle's highs, the middle EMA on the close, and the lower EMA on the lows. TradingView users can utilize the moving average ribbon indicator. Navigate to the indicators area, search for moving average ribbon, pick it, and alter the settings accordingly. Your chart should now resemble the following configuration. These moving average bands will help you spot trade chances when the price is trending. They will function as both support and resistance levels. In an uptrend, the price frequently returns to the moving averages and finds support. In a downtrend, the price pulls back to these moving averages and meets resistance. It's important to remember that the price doesn't always bounce exactly from the bands. It can move deeper before reversing. Now let us combine this with the MACD to develop a strategy. Here's a buying setup. The price rose sharply and held above the upwardly sloping bands, indicating an uptrend. When the price returns to the EMA bands, we expect it to find support and continue its upward trend. We also see that the MACD line has crossed below the zero line. In an uptrend, we expect the price to bounce after the MACD crosses the zero line. This means that the hiding is gone, and the price may resume its uptrend. As a result, we get confirmation from both the MACD and EMA bands. For our entry, we will not use the MACD line crossover for this method. MACD crossovers are useful for recognizing reversals, but they are less dependable for detecting pullbacks, which frequently result in late entrances. For a better entrance, we will build a short-term trend line on the pullback and when it breaks. As indicated, the price increased significantly following our entry. Here's a sell trade example. The price consistently traded below the downward sloping EMA bands, indicating a significant downtrend. When the price returns to the bands, we expect it to encounter resistance and fall. Additionally, the MACD has crossed above the zero line, implying that the price may resume its downward movement. This creates confluence between the MACD and EMA bands. Then, we establish a short-term trend line and wait for the price to break it. On this candle, the price breaks below the trend line, indicating a sell trade. As shown, the price fell after our entry. Strategy 4. Swap zones plus zero line pullbacks. If you trade support and resistance, you may be aware that these levels have dual qualities. A resistance level can transform into a support level following a breakout and vice versa. This is why we call them switch zones, because they alternate responsibilities with one another. This approach will be used with the MACD to trade this method. Here's an example. The price was steadily rising and we detected a reversal point, sketching a resistance level. After the price broke over this resistance level, it became a support level. When the price returns to this new support level, we expect it to bounce and move higher. We also see that the MACD line is below zero, signaling probable support. We detect a doji candlestick right at the support level, so we purchase. As shown, the price rises and trades higher. Now let's look at a sell trade. The price was in a decline, and we discovered a reversal point to establish a support level. After the price broke below this level, it became a resistance level. We predict the price to bounce back down once it reaches this resistance level. We can also observe that the MACD has gone above the zero line, which confirms our judgment. We enter a sell trade when we see evening star candlestick formation. As you can see, the price fell when we entered. In this video, we first looked at how to use the MACD indicator before discussing 4 advanced trading methods. Also, if you found it useful, please like it and subscribe to our channel, Trader Yoda, to ensure you don't miss any future videos. Thank you for watching, and we will see you soon.